Hello everyone. This video is going to provide you with a brief overview of long-term liabilities. If you look at your slide, we'll see that first we'll cover liabilities. We'll talk about the difference between current and long-term liabilities. We'll get into installment loans, where we'll talk about their key characteristics, what we mean by amortizations, how loan payments are determined, and the effect that installment loans have on the accounting equation. We'll finish up the presentation by talking about bonds, their key characteristics, what we mean by amortization as related to bonds, how the price is determined, and the effect that bonds have on the accounting equation. Remember, liabilities are debts owed to creditors, and they represent probable future sacrifices of economic benefits. Think of them as promises the company has made that will require giving up cash or other assets in the future. Now here's a crucial distinction: current versus long-term liabilities. Current liabilities are debts due within 1 year. Things like accounts payable, wages owed to employees, and short-term notes. These get paid typically with current assets like cash. Long-term liabilities are typically big commitments. They're debts that extend beyond 1 year. Now we're talking about installment loans, bonds, mortgages, lease obligations, pension promises to employees, and future tax obligations. These represent the major financing decisions that shape a company's future. In this class, we're going to focus on two key long-term liabilities: installment loans and bonds. Let's dive into installment loans first. These are probably the most familiar to you. Think about car loans or home mortgages. Key characteristics: these loans are repaid through a series of periodic payments over time. Here's what makes them interesting from an accounting perspective. Each payment includes both principal and interest, but the split changes over time. Early in the loan, most of your payment goes to interest. As time passes, more goes towards principal. The interest is always calculated on the outstanding balance. So as you pay down the principal, the interest portion will decrease. The amortization process works like this. Interest equals the outstanding balance times the interest rate. Your principal payment equals your total payment minus the portion that goes to interest. Your new balance will equal the previous balance minus the principal payment. A great tool to use for installment loans is an amortization table. An amortization table is a schedule that'll show each payment, the payment breakdown over the entire term of the loan. Determining the loan payments allows you to put your TVM skills into action. The N will be the number of payment periods over the loan term. I will be the period rate for the loan, typically monthly, so you take the annual rate, divide by 12. The PV is the amount that you intend to borrow. Once you've entered your amounts, compute the payment, and you got it. The beauty of the payment calculation is that it allows you to determine the affordability of the borrowing before you commit to anything. For accounting purposes, when you borrow money, cash increases and notes payable increases. There's no effect on stockholders' equity at the time of the borrowing. When you make payments, cash decreases, notes payable decreases, and interest expense reduces stockholders' equity. That's all there is to installment loans. They're loans that require periodic payments. The payments include both principal and interest, and as time goes on, the carrying value or amount owed on the loan will decrease until it becomes zero when the loan matures. That's all there is to it. Now let's tackle bonds. These are where things get really interesting. Bonds are debt securities issued by businesses or governments to raise capital from multiple investors. The key characteristics you need to know is that every bond has a face value, the amount paid at maturity. The stated rate is the interest rate printed on the bond, and it's used to calculate interest payments. But here's where it gets a little tricky. The market rate is the current interest rate investors demand. And so it's the market rate that determines the bond's actual value and interest expense. The term is the time to maturity. And at maturity, it's important that you realize the balance of the bond will be the face value. When it comes to pricing the bond, we rely totally on time value of money calculations. We're going to calculate the present value of the face value as well as the present value of all of the cash payments. The N is the number of cash payment periods that are made until the bond matures. Most bonds make payments semi-annually. The I is the periodic interest rate based on what's going on in the market. So you're using the market rate of interest. The payment are the cash interest payments, which are based on the stated rate for the bond. And the future value is the face value of the bond. The price of the bond or its current value is determined by computing the present value. When the stated rate equals the market rate, the bond sells at face value. We call this selling at par. But what if rates don't match? If the stated rate is higher than the market rate, the bond sells at a premium above face value. Investors will pay extra for a bond that pays more than current market rates. If the stated rate is lower than the market rate, the bond sells at a discount, below face value. Who wants a bond paying less than what you could get elsewhere? The market rate will always serve to adjust the bond price to ensure that investors are receiving the return currently in place. Amortization is crucial for bonds. We use the effective interest method. For premium bonds, we decrease the carrying value over time. For discount bonds, we increase the carrying value over time. The goal? By maturity, the carrying value always equals the face value. When we look at the accounting equation, at the time bonds are issued, our cash increases and our bonds payable, which is a liability, increases. There's no effect on stockholders' equity. During the period, as cash payments are made to investors, cash decreases, the premium or discounts are amortized, and stockholders' equity will decrease because interest expense is recorded. At maturity, cash will decrease, bonds payable will decrease. There's no effect Bonds and other long-term liabilities can be complicated. So here's what you really need to remember. Long-term liabilities represent significant commitments that extend beyond 1 year. Whether we're talking about installment loans or complex bond arrangements, the key principles remain the same. We recognize the liability when the obligation is incurred. We track interest expense over time, and we systematically adjust the carrying value through payments. These aren't just accounting entries. They represent real business decisions about how companies finance their operations and growth. Understanding long-term liabilities helps you see how companies balance current needs with future obligations. The bottom line is that long-term liabilities are the price companies pay for using other people's money to grow their business. Master these concepts and you'll understand a major piece of corporate financing. Thanks for watching the video. Good luck with your studies.